The U.S. markets are currently closed. As of the closing bell on Monday, October 13th, 2025, Nuburu, trading under the ticker symbol BURU, finished the session at $0.1152. This represented a significant intraday drop, down 0.0088, or a decline of 7.10%. Now, at first glance, a 7% drop on a sub-dollar stock might seem like just another volatile day in the world of microcaps. Many might dismiss it as noise. However, the real story isn't the percentage change itself, but the underlying mechanics of that price action. What we witnessed was not a panic sell-off on high volume, but rather a slow, grinding erosion of value on relatively thin trading, a sign that the pool of speculative buyers is getting shallower, while the few remaining sellers don't even need to be aggressive to push the price down. This is a subtle but critical distinction that points to a deeper issue of waning conviction. The common narrative surrounding Nuburu is one of a classic high-risk, high-reward tech play. The expectation is straightforward. Here is a company with a potentially transformative technology, high-power blue lasers for industrial applications, especially in welding copper, a crucial component in electric vehicle batteries and electronics. Investors see a stock that once traded for dollars, now available for pennies, and the mental calculation is simple. They imagine that if the company can just secure one or two major contracts with an automotive or battery manufacturer, the stock won't just double or triple, it could see an astronomical rise. This is the story that gets told in forums and social media, the hope that fuels the buy button on platforms like the Robinhood app or through a SoFi Invest account where fractional shares make even a small bet feel accessible. The expectation is that you are getting in on the ground floor of the next big thing in advanced manufacturing. But the reality of the situation is far more complex and sobering. The current market behavior of BURU stock has very little to do with its long-term technological promise and everything to do with its short-term financial survival. The company is in a precarious position, grappling with significant cash burn, the looming threat of delisting, and the constant need to prove its commercial viability against a ticking clock. The recent 1-for-25 reverse stock split was a clear indicator of this distress. While the move was necessary to regain compliance with the NYSE American's minimum bid price requirement, reverse splits are often perceived by the market as a cosmetic fix that doesn't address the fundamental problems. They are a tool to stay on the exchange, not a tool for building a sustainable business. For seasoned investors using more sophisticated platforms like interactive brokers, such a corporate action is a massive red flag, signaling that the company is struggling to maintain its market standing through organic growth and investor confidence. The reality is that the stock isn't trading on its future potential, it's trading on its balance sheet and its current quarter's cash runway. Let's dissect the recent trading patterns more closely. The 7.10% drop occurred on a volume that was unremarkable. This is key. When a stock plummets on massive volume, it suggests a broad-based capitulation. But when it drifts lower on thin volume, it indicates apathy. It means there aren't enough new buyers willing to step in and absorb the shares from the sellers. The bid-ask spread for BURU is likely widening, making it more expensive to get in and out of a position. This kind of price action is treacherous for the average retail trader performing their online investing from home. While they might see a cheap stock, institutional players see an illiquid security with substantial risk. You won't find Nuburu in a Schwab Intelligence portfolio or in the top holdings of major Fidelity mutual funds. The professional money, the kind managed by Fidelity Wealth Management, stays away from situations like this precisely because the risk of being unable to exit a position without severely impacting the price is too high. This is a market primarily driven by retail speculation, a tug-of-war between hope and the harsh reality of corporate finance. The company itself, Nuburu, focuses on a fascinating and genuinely important niche. Its blue laser technology addresses a significant challenge in manufacturing, welding highly reflective metals like copper and aluminum. aluminum. Traditional infrared lasers struggle with these materials, as much of their energy is reflected away. Nuburu's blue laser, with its shorter wavelength, is absorbed much more efficiently, leading to stronger, faster, and more reliable welds. The applications are obvious and compelling, from constructing the bus bars and battery packs for electric vehicles, a sector dominated by giants like Tesla stock, to advanced applications in consumer electronics, a field where a company like Apple stock sets the pace. The technology is not the issue, it is genuinely innovative. The problem lies in the bridge between having a great idea and having a great business. This involves scaling production, navigating complex industrial sales cycles, and, most importantly, managing capital until revenues can sustain operations. The company's past earnings reports have shown some revenue growth, but this has been consistently overshadowed by significant net losses and operating expenses. Looking ahead, the future of Nuburu hinges on a few critical factors, creating a stark binary set of possible outcomes. The bullish scenario, the one that fuels the dream of a multi-bagger return, rests entirely on the company's ability to announce a landmark deal. A partnership with a major automotive OEM or a top-tier battery manufacturer would be the ultimate validation. It would not only bring in substantial revenue, but would also signal to the broader market that Nuburu's technology is not just theoretically superior, but commercial essential. Such a development would almost certainly trigger a massive short squeeze and a dramatic re-rating of the stock. It's the catalyst everyone holding shares through their individual brokerage account is waiting for. This is the expectation. The company needs to show the market that it can convert its technological edge into tangible, recurring revenue streams, moving beyond small-scale projects into high-volume production contracts. However, the bearish scenario, which the current stock price action suggests is the more probable outcome in the market's eyes, is equally stark. The primary risk is financial exhaustion. The company's cash reserves are finite, and with negative cash flow, there's a constant threat of needing to raise additional capital. In the current market environment, with elevated interest rates, raising funds is difficult and expensive for any company, let alone a speculative microcap. Any new financing would likely come in the form of a dilutive equity offering, where new shares are sold at a low price, reducing the ownership stake and the value of the holdings of existing shares. This is the reality that tempers the technological optimism. Another significant risk is competition. While Nuburu has a strong position in blue laser technology, it is not the only company working on advanced industrial laser systems. Larger, better capitalized competitors could develop alternative solutions, or even a similar technology, and leverage their existing manufacturing scale and client relationships to box Nuburu out. The path from a great product to market dominance is littered with obstacles. Given the challenges with cash burn, comment below with your prediction. Will Nuburu secure a major manufacturing contract before it needs to announce another dilutive financing round? When you analyze a stock like Nuburu, you have to use a different framework than you would for a blue chip like Nvidia stock. With Nvidia, the debate is about the valuation of its immense and growing profits. With Nuburu, the debate is about its very survival. This is why it's a stock that finds more traction on platforms designed for active, high-risk trading, such as the Robinhood stock trading interface or the more advanced tools offered by Interactive Brokers trading platform, rather than long-term set-it-and-forget-it investing sites or robo-advisors. It requires constant monitoring and an understanding that the entire value proposition could change with a single press release, either for the better or for the worse. Self-investing in a name like this demands a high tolerance for volatility and the willingness to lose the entire principal. This is the polar opposite of a diversified strategy using fidelity ETFs. This is a focused, speculative bet on a specific technological and business outcome. In conclusion, the story of Nuburu is a classic clash between an exciting technological prospect and a difficult financial reality. The expectation, held by a small but hopeful group of investors, is that the company's superior blue laser technology will inevitably find its place in the booming EV and electronics industries, leading to a massive recovery in its stock price. The reality, as reflected by the persistent downtrend, the low institutional ownership, and the necessity of a reverse stock split, is that the company is in a race against time. It must achieve commercial scale and profitability before its financial resources are depleted. The 7% drop on a quiet Monday is not just a random fluctuation, it's a symptom of this underlying tension. It speaks to a market that is growing more skeptical, waiting for proof that Nuburu can make the critical transition from an innovative research and development firm to a financially robust industrial supplier. The ultimate outcome remains unwritten, but for now, the risk of failure is being priced in far more heavily than the potential for success. Blue disclaimer: this video is for educational and informational purposes only. It is not financial or investment advice. Always do your own research and consult a qualified financial advisor before making any investment decisions. Like,